Hello, everyone. My name is Zach Gass, Global Head of Research at CFRA. I'd like to welcome everyone to today's webinar, Putting Pullbacks into Perspective. Before we get started, I wanted to remind everyone that today's session is being recorded, and a link to that recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar questions panel, and we'll do our very best to answer as many as we can. Now, over the last couple of weeks, the questions I'm getting from clients have become increasingly focused on downside risk. In assessing that issue, I thought we could all benefit from hearing from my colleague, Sam Stovall, CFRA's Chief Investment Strategist. He'll discuss how long this decline might last and how deep prices could fall, and more importantly, how quickly could we recover and which groups could lead the way. Sam serves as analyst, publisher, and communicator of CFRA's outlook for the economy, market, and sectors. Sam's the chairman of our investment policy committee, where he focuses on market history and valuations, as well as industry momentum strategies. Before we dive in, I'd like to provide some context on CFRA. Most of you know CFRA through its stock analysis or forensic accounting. Today's topic instead features some of our work on strategy and industry themes. By the numbers, you can see that today our analysts cover more than 1,500 stocks, 1,800 ETFs, and 22,000 mutual funds. Sam's analysis ties that all together, and because this is a short webinar, on that note, I'll turn it straight over to Sam.
Great. Thank you, Zach, and thanks everybody for tuning in. Yes, we're all trying to figure out how long, how far this pullback is going to last. So let's take a look at the carnage that we've experienced so far. Year to date, as you can see, so 12/31 through the market peak on 9/20, the S&P 500 was up 9.6%, and we had 9 of the 11 sectors in positive territory. Yet everything came to a screeching. And so now we have the sectors sorted in descending order of declines. So with materials and industrials getting hit the hardest, the S&P 500, second from the bottom, we see down 9.9%. On a closing basis, technically the S&P is still in pullback mode. I define declines of 0 to 5% as noise, and obviously the closer we get to 5%, the louder the noise. And then beyond that, we're in 3 different kinds of categories. Pullback is a decline of 5 to 9.9%. Corrections are 10 to 19.9%, and then bear markets are 20% and higher. What's interesting is that people forget that declines of this sort are fairly commonplace. That technically, when you go back to World War II, you look at all the months in which we were in bull market territory that were also not going through other pullbacks or corrections. Pullbacks occurred essentially every 9.4 months. So at least once a year, we end up declining anywhere from 5 to close to 10%. And then we get back to break even. Excluding pullbacks, we have corrections about once every other year. So 25.2 months is the number of corrections we've had divided by the number of months in bull markets. And then lastly, we have bear markets occur essentially once every 5 years. Now, what's interesting is in the next slide, we see that we have actually had 56 pullbacks since World War II. The average decline was 7%, and it took 1 month to go from peak to trough. This is all on a closing basis. So you could technically say what we're experiencing right now is a textbook pullback because we've declined almost 10%, and it took 39 calendar days, or about 1 month, in order to go from peak to trough as it stands right now. Should this be all we get, and that the market then turns around and gets back to the 2930.72 level that we saw on September 20th, investors would be surprised with the speed with which we get back to break even, which actually would be fewer than 2 months. It's about 1.5 months on average. If, as I think will be the case, this pullback morphs into a full-blown correction, which is a decline of 10 to 20%, we've had 22 of those since World War II. Average decline is 14%, and that's as far as I think we're going to see with this correction, based on technicals, based on history, etc. I think we do end up declining 15% when all is said and done. Yes, it might take 5 months or might be quicker than that, because of how fast things move these days. But probably most important is the speed, again, with which we get back to break even. These 22 corrections since World War II, we got back to the break-even point, got back to the starting point in only 4 months after reaching bottom. So what's interesting is if you add the 56 pullbacks, 22 corrections with the 12 bear markets, 86% of all declines of 5% or more got back to break even in an average of about 4 months. So people might be very smart knowing when to get out, but chances are they're still in, or I should say they're still out of the market when the market does finally get back above where they got out and probably close to the break-even point before investors get back in. If we take a look at this chart, this is not someone's EKG diagram. It would be in red if it were. What this shows is a rolling weekly percentage. What percent of the 149 sub-industries in the S&P Composite 1500 are trading above their 10-week or 50-day moving average? As you can see, we most recently broke below 2 standard deviations from the mean. So we see the orange line up top, that's 1 standard deviation above the mean. We then see the black line at about 34%, that's 1 standard deviation below the mean. And then at 8% is 2 standard deviations below the mean. So we were beaten up pretty badly, and we saw only about 5% of the sub-industries in the S&P 1500 trading above their 10-week moving averages. So at least in the near term, we could end up seeing a meaningful pop before we retest the bottom and possibly even break to a new low. Are we there yet? I don't really think so. I also monitor volatility. Take a look at the far right-hand side. You'll see where we are right now. This is a rolling 30-day average of the intraday price volatility for the S&P 500. Interesting, but about a month to month and a half before the bottoms of corrections over the last 20 years has occurred, when we have seen this kind of stalagmite spike in volatility. Now you might be thinking, well, wait a minute, November 14th of 08, that was nowhere near March 9th of 09. Well, actually, when you look at individual stocks, a majority of the individual stocks did indeed close in the latter part of November of 2008. And March 9th served as a successful retest of that low. It was only because we still had some shaking out to do in the financial sector, et cetera, that brought down the overall index. But a majority of individual issues actually saw their lows occur in late November of 2008. Take a look at 2011, 9/14. The bottom actually occurred on 10/3. So this ends up being a good indicator, because once we break above 1 standard deviation, and in the case of multiple of these corrections and bear markets, when it breaks above 2 standard deviations and then starts to come back, that indicates that the worst is probably behind us in terms of volatility. Unlike volcanology, where you can use seismic activity to decide when Dante's Peak is about to blow, you really can't use that with the beginning of corrections or bear markets, or at least I've not discovered how to do so. But I do find that volatility does end up being a good indicator when things are all said and done. Most traders that I talk to are saying that they are still waiting for that capitulation sell-off, that shakeout of loose hands, before they believe that the bottom has been put in place. So I think right now what we are simply experiencing is more of an oversold technical rally before we head even lower. In the next slide, what we'll see is This is also not unusual that we have had declines of 5% or more than once in a calendar year. This is actually the 19th time that we have had 2 declines in 1 year. Add 8 more years, you can see that we've had multiple times that the S&P has declined by 5% or more, gotten back to break even, only to fall by 5% or more multiple times in that same calendar year. What is disconcerting, however, is that about 70% of the time, the second decline was deeper than the first one. So that's the first indication that maybe we have further to run before the bottom is put into place. Also, looking at some technical charts, seeing the other levels over the past several years at which the S&P 500 bounced was around the 2580 level. So I would tend to say, also reading up on our technical research, which says that this zone actually extends down to around 2530, that would imply about a 14% decline. So that's why I'm coming up with that overall average correction level to be experienced for this decline has fully run its course. What is driving all of this? Well, it's investor worries. I like to say it's PEs, politics and earnings. Earnings seem to be the biggest concern right now, that we are at or approaching a peak in year-over-year percent change in rolling 12-month operating results. Investors are also worried about the Fed's fixation on raising rates, even though it is having, or at least contributing to, the volatility and decline in the S&P 500. We also have the midterm elections. Normally, the second and third quarters of midterm election years have posted declines on average, yet this time around, all 6 months were positive. So, like the old AMCO commercials, you can pay me now or pay me later, and we are experiencing all of that decline in one concentrated period thus far in October. And then lastly, the trade tension. So worries about what is going to happen with trade between the U.S. and China, with U.S. and Europe, U.S. and other areas, and will that end up leading to a global recession? As we see in the next slide, yes, history does say we have to be stepping very gingerly these days, because we are in a period in which the market has going to be experiencing a peak in earnings growth. This blue line is simply a rolling 12-month percent change, meaning sum up 4 quarters of earnings and then divide that by the prior sum of 12-month earnings. Map that out, and then take a look at the shading, which show declines of 10% or more. The average earnings increase has been about 7.8%, but what we see is with this earnings slowdown that, yeah, traditionally it does tend to precede market declines, and we're obviously going through that right now. The orange line to the far right-hand side of this undulating blue line is the projected operating earnings trend over the next several quarters. We anticipate a rolling 12-month peak to occur by the end of the fourth quarter of this year, with gains a slight above 22%. But then as we move to the end of 2019, earnings are expected to be up 9.3%. So yes, I can see this correction occurring. I'm calling it more an adjustment to the angle of ascent in terms of share price appreciation. But because we anticipate GDP growth to be up 2.7%, Q4 over Q4 in 2019, because we are still looking for 9+% earnings growth for 2019, and we look at other economic indicators, we don't see a recession on the horizon. And even though bull markets are like humans in that the older they get, the more unstable they become, we don't think that this market, because of its age, is simply headed toward a recession. We have to look to earnings, we have to look to economic growth, etc., and we just don't see a recession on the horizon. However, that said, I think analysts are basically falling over themselves to try to slash their earnings growth estimates. in the period ahead. Third quarter, they can't really do much slashing because now it's simply a matter of reporting. I have shaded in orange those sectors that are actually seeing a reduction in their earnings projections. So we can see communication services and materials, communication services at 15.2% growth versus the end of quarter estimate of 15.3. So a very modest decline, but a decline nonetheless. Materials were expected to be up 43.4, now expected to be up 40.7. And then looking at the benchmark sizes, the S&P Small Cap 600, instead of getting 23.6, is now 23.3. Big deal. But we're starting to see some reductions for 2018's fourth quarter, and also take a look at the far right. For as many reductions in the third quarter of 18, we're having a flip number for the full year of 2019, meaning that 9 of 11 sectors are seeing downward revisions to earnings estimates for all of 2019 as compared with their 2019 estimates on September 30th. Mid-cap and small cap, interestingly enough, are seeing slight upticks. But what it's basically showing is that, yes, analysts are going through the process of revising lower their earnings estimates. So the real question is, how far down do we go? Normally, the analysts will overshoot to the downside, just as they do to the upside, constantly trying to work their way around the appropriate number. But as we see in the next slide, I guess the question is, well, how far down can we actually go? Where is fair value for the S&P 500? I use something called the Rule of 20, which looks at PE ratios in conjunction with inflation. Think of it as a scale. Why is it that we had 2 bear markets start when PEs were below 10? It's because inflation was in the teens, the mid-teens. So like a scale, if you have very high inflation, you can only support low PE ratios. Turn that on its side, however, right now we're looking at the second lowest quintile of inflation since World War II that traditionally can support higher PE ratios. So looking at the Rule of 20, applying that to the current year-on-year change in core CPI at 2.2%, the implication is that fair value is somewhere around 28.73 based on the Q4 earnings of $161.38. That is about a 8.8% gain on the S&P 500 based on 1029 closing value. What about for the end of 2019? Well, in that case, our estimate is that core CPI will be showing a 2.5% year-on-year increase. Now the question comes down to what kind of earnings should we expect to see at the end of 2019? Will we be getting the estimate as is forecast currently at 176.36, or will we get half of that, 168.87? What I mean by half of that is half of the growth that is anticipated currently. Or what if we get no growth whatsoever and that earnings come in at the end of 2019 the same as they are expected to be 2018? We'll take a look at the right-hand side and you'll see what the percent change is based on these estimates. So with the Rule of 20, based on these earnings, based on these CPI projections, the Q4, based on current earnings estimates, is close to our 12-month target of 3,100. This would point to 30.86. If earnings growth was half that, however, we'd come in a shade below 3,000 at 29.55. And then if we got no growth at all, then 28.24, which would actually be a year-on-year decline from where we see the market ending this year. And toward the right-hand side, you'll see the 16.8, 11.9, and 6.9. Those are the percent changes from current levels. So there's still the possibility of us being higher by as little as 7% and as much as 17% in the coming year. As we see in the next slide, you could actually say, gee, there's something to look forward to. While the U.S. stock market, as defined by the S&P Composite 1500, which consists of the large cap 500 plus mid cap 400 plus small cap 600, earnings growth of 23.4 is expected to be more than cut in half to a growth of only 9.8. Yet looking overseas, the less than 3% earnings growth is expected to be triple 9% earnings growth by the end of 2019. And in the emerging markets area, areas that nobody has wanted to own, the 5.6% growth is more than doubling to 14.1. Of course, these earnings estimates could come down as well, but I think what it's saying is that if investors are looking for opportunities, they might want to rotate rather than retreat entirely. As we look at this slide, this gives me reason to believe that we're not headed for a bear market. No bear market started since 1955 with the Fed funds minus CPI differential being this low. What I mean by that is the Fed funds has traditionally been 2.5 percentage points above the year-on-year change in headline CPI going back over 60 plus years. So Fed funds minus CPI has averaged about 2.5 percentage points. The lowest differential, which occurred in the late 1950s, was 0.83, so meaning that the Fed funds rate was 83 basis points above the year-on-year change in headline CPI. If we add a rate hike in December of this year, and then actually add 3 more rate hikes to 2019, we will still be below that 0.83 lowest differential over the last 60 plus years, provided obviously that the CPI is where we think it'll be at about 2.5% a year from now. So with interest rates this low, with the Fed pretty much telling us when they're going to raise rates, by how much, et cetera, I think that if we do fall into a bear market, it probably won't be because the Fed warning us well in advance to watch out for a left hook. Also, because this market is, in a sense, experiencing the decline it normally sees in the second and third quarters of midterm election years all in 1 month, it's almost like an overweight diver jumping onto a diving board that really is brought down pretty low, that could end up serving to launch us once this midterm election has run its course. The average fourth quarter price change in midterm election years has been a gain of 7.5%, and the frequency of advance, the batting average, is almost 90% of the time. Obviously, that's not 100%, and even if it were 100%, that would still be no guarantee that that would happen this time around, but we can't really rule out seasonals being on our side. Also, since Q4 of midterm election years are the best quarter of the 16-quarter presidential cycle, it's reassuring to know that the next 2 quarters are the second and performing quarters of the 16-quarter presidential cycle. So again, were history to at least rhyme, if not repeat, then there could be some upside potential available to us in the 3 quarters ahead based on historical precedent. We also know that we are ending what's called the sell-in May period, the May through October period, in which the market has gained only 1.4% on average. Some people like to say sell in May and go away, and I think they probably wish they had done so. But we are also quickly approaching the cyclical 6 months of the year, those best 6 months of the year in which the market has been up 6.6% on average, and gravitating from the healthcare and consumer staples sectors, which tend to do best from a seasonal perspective, into the more cyclical consumer discretionary, industrials, tech, and materials sectors in that 6-month period ahead. Add one more bit of historical trivia, and investors can feel optimistic about the post-election pop, PEP, for a pep talk, if you will. In the 12-month period from October 31st of midterm election years through October 31st of the year after, the S&P 500 has risen 18 of 18 times and was up an average of almost 17%. Even if we have a majority change in Congress, as shown by the orange bars, the average gain has been about 13%, Whereas if we get no change in congressional makeup, then we end up with the blue bars, which tend to be closer to a 20% advance. So what we see essentially is that, again, seasonals are telling us, you know what, once the selling has run its course, maybe there could be some seasonal strength that at least gives us a short-term pop, if not allows us to emerge from this average correction that we might be experiencing. So with that, the question could be, well, what looks attractive? And this slide shows a very quick screen to say, using weekly data going back to the end to September 21st through last night, what I found was that these are the sub-industries. The column head 1 week should really read this entire decline, so 9/20 through last night. We see diversified chemicals, copper, construction machinery, all down more than 20%. Yet those are the areas that we think have the best potential to recover, and we have very favorable stars recommendations for companies within these sectors. Our stock appreciation ranking system, our analyst-driven buy, hold, and sell system, offers some favored guidance for some of these fallen sub-industries. Go on to MarketScope Advisor, use the screening tool to find out within consumer chemicals or diversified chemicals which stocks specifically have the highest rankings, ditto for copper, construction machinery, leisure products, etc. Lastly, to sum everything up, I call myself a bull, but with a lowercase b. We have a 12-month target of 3,100 for the S&P 500, which, as I mentioned, is based on current earnings estimates. So looking for good growth based on how low we have gotten and will likely go. GDP growth, we don't think is going to be tumbling into a recession around the globe. Like the IMF, 3.7% is our estimate this year and next. Year on year, yes, we have tougher comparisons. So the 2.7% growth for 2019 is because the 3.1 is expected to be pretty strong for 2018. We don't see inflation being a big headwind. 2.5% is our year-on-year growth in the fourth quarter of next year. We think the Fed will raise rates in December and then currently have 2 rate increases for 2019, not 3 as the street is looking for. 10-year yield will be below 3.5% in our opinion by this time next year. Oil prices continue to undulate, but probably work their way higher as the year progresses. We think much of the strength has already been factored into the Federal Reserve Board's major dollar index. Revenue growth, yes, because of tougher comparisons, the 8.8% growth this year will come down to about 6% growth in 2019. Ditto for earnings. Instead of the 22 plus, we'll end up with below 10% earnings growth, and that number is probably going to be revised lower in the quarters ahead before they then get raised as we probably see earnings come in not as bad as people are anticipating right now. So Zach, with that, I will turn it back over to you, and we can also open up for some questions.
Yep. Thanks, Sam, so much for that. I think we just have time for one question, and we've got a few in the queue, so I'll just pick one, and then we'll wrap up from there. So the question we got online is, one of the market concerns today is the potential for significant inflation, which I think you alluded to, Sam. What's your view on that, and what would it mean for the market?
Well, first off, we don't see a large pickup in inflation. I mean, that's something that people have been anticipating for quite some time. I think you just think about it, all the apps on your phone that are bypassing the middleman and making things cost less and less over time. That's one reason why the Consumer Staples Group is having such a challenging period beyond the flight to safety benefit they've experienced over the last couple of weeks, is because they have not been able to raise prices, and as a result, their profit margins have been shrinking. Take a look at the baby boomers who don't want to leave the workforce. They're not banging on their manager's door saying, give me a raise or I'm out of here. So we are not finding inflation to be a big concern. We have some people who are saying, well, that's really just a conspiracy thing. The government doesn't want inflation to be registered as being elevated. Well, gee, if that were the case, don't you think that the president, when he was campaigning, would have shown that he was a true outsider by claiming that inflation is a government conspiracy and that he will relieve all conspiracies? Well, that was never mentioned. So I think if people have a problem with inflation, it's because nobody has come up with a very accurate, perfect way of measuring inflation. But using the flawed method as we have now, the core PCE came in most recently below the Fed's target of 2%. The core CPI is at 2.2, headline slightly above that. I think the Fed's major worry is that inflation becomes disinflation, becomes deflation. Then it becomes a downward spiral as consumers say, you know what, maybe I'll wait till next week or next month to buy this product, to enlist this service, to rent this apartment because the prices will come down. Well, that kind of a downward slide is very, very difficult to get out of. And so that's why I think the Fed is very willing to let interest rates run to a point, because right now they're still quite stimulative with the Fed funds rate being below the rate of inflation. As I mentioned, normally it's almost 2.5 percentage points above before a bear market kicks in. So we're still in a net negative real rate environment. I don't see inflation as a worry, but what if I'm wrong? Well, then I believe that we have to think about that scale. The higher inflation goes, the more that PEs have to be adjusted downward in order to reach that rule of 20. And the lower we go, the deeper into a correction we would slide, and if need be, go into a bear market. But that's not something I anticipate. 10-4.
Great. So I think that's all we have time for, but on behalf of the team at CFRA, I'd like to thank everyone for joining us today. Within the next day or so, you should receive a note from us with a link to the replay and slide from today's session. If you have any questions, please don't hesitate to contact us at cservices@cfraresearch.com. And in the meantime, please check out CFRA's MarketScope Advisor for our latest research and strategy notes. If you're not currently a subscriber to MarketScope Advisor, please contact us again at cservices@cfraresearch.com or visit our website, www.cfraresearch.com, to learn more about the website and to receive a complimentary 2-week trial. Lastly, I'd like to invite everyone to join our next webinar, Find and Analyze New Investments with Portfolio Tools, which CFRA will host in conjunction with Advisory World on Thursday, November 8th, 2018 at 11 a.m. Eastern Time. A link to the registration page will be sent to you later today, and we hope you'll be able to join us for that session. Once again, thank you all for joining us today, and we look forward to speaking with you soon. Bye-bye.